Hello, this is Ken Moore with Global View Investment Advisors. I want to talk to you today about where we are in this COVID crisis investment-wise, a little bit about the economy too, and also to share with you at the end a hopeful message, as well as discuss where we see opportunities. So hang on with me while I get this started. So the question today is there anything left? Some investors may be asking, with the big rally that we had, and we had the worst downside since the Great Depression, and then we had a very swift rally in U.S. equities, particularly in technology. So the question is there any fruit, low-hanging fruit on the trees? Is there any fruit still on the trees? And I'd like to say that, there's some of the fruit has been plucked. There are few opportunities now in the large cap tech universe. The obvious consumer staple names are fully valued, but that really doesn't tell the whole story, because 5 stocks now, I think, are 25% of the S&P 500, and they're the big tech stocks. So if you look further down and you look within even this S&P 500, but also if you look within the smaller cap universe in the United States, and especially if you look outside of the United States, you see a lot of opportunities. And there remains a bifurcated bond market. In other words, some of the bonds rallied hard, depending on how the U.S. government supported them, and other bonds suffered. So let's talk about, we're going to talk about that a little bit. But in particular, the bond markets that have suffered are those, in many ways, which were the safest going into the crisis, which we still believe to be quite good if we don't have an extended, long crisis with this pandemic that isn't resolved, if we don't have a vaccine, if we can't open up again and we don't see that we're able to manage it. So we think that within the residential mortgage-backed securities, there's especially a big a big opportunity. But there's also one within the other structured credit markets, as well as the collateralized loan obligations that own corporate bonds. Those things are still trading at ridiculously low prices. That is really a technical side effect of there not being a really good market for them. The good news is that the risky players who were over leveraged in those have de-levered, so the chance of downside has gone away substantially, unless there is in fact a major credit event where they can't be repaid. Now, of course, within the corporate market, that's going to be the case. There are also going to be some mortgage owners who can't repay, but we see a lot of opportunity there. So the biggest question we discuss amongst ourselves and with other portfolio managers, and I've been on some fascinating calls in the last few days, even, especially yesterday, there are 2 scenarios for economic growth. We're going to have a significant recession or a severe recession, which you might call a depression, which I don't think is any likely anymore. So the equity market's still a stock picker's delight, and there's unprecedented opportunity in some of the fixed income markets. So where are we now? This chart at the bottom shows that it looks like there's a U bottom, and this is what some of the smarter economists were predicting going into this crisis, that we'd have a sharp drop, a flattish bottom sloping slightly upwards, and then a sharp increase. So that sharp increase could happen at any time, and of course those companies that are going to do well whatever happens have done quite well in the rally. And then some of the other companies that depend on when do we start again have taken some more time, but you still have some of the individual oil and gas midstreams, for example, trading at half what they were in January because oil prices are so much lower. So the economy appears to have bottomed. The question is how quickly does it restart? The unemployment rate's already 14.7%. So we looked at this under two scenarios, where unemployment peaks at 20%, and we're at 10% by the end of the year, and where it's severe. In other words, it goes to 25% of the population's unemployed, and it stays that way for a year and a half, 2 years. Now, I also put in here Morningstar's assessment of how have various places around, or how has the U.S. versus the world responded with economic policy. And they give us a high grade, but the world not such a high grade. It's harder to resolve some of the issues in especially emerging markets, but also in Europe. It's harder for them to use the same stimulus in some ways. There's unlikely to be a financial crisis. There aren't any structural economic issues. There's some economic damage, but not a lot. Overall, the long-term economic impact is going to be low. Less so probably than during the Great Recession, the Great Financial Crisis. Investors sold heavily bonds and stocks here in the orange you see, managed bonds and taxable bonds in particular, with hardly any movement in the other sectors. And you see that they've sold off other things, including stocks, and bought back into bonds to some degree in April. These sales were in March. So you see U.S. equity over the last 12 months, there's been $100 billion sold, but we're still net positive in taxable bonds. The big outflow was in March when people were spooked because guess what? Not everything's absolutely risk-free. It doesn't exist in the world. So again, here's the historical low outflows. This is the worst that there's ever been seen on record in a month. 109 billion outflows, which through March 31st. And you can see investment grades went way out, and so it happened throughout the weeks here in March. And then you can see the drop of the US S&P 500, which caused people to panic, is worse than 1987 and then 1929 over that 40-day period, which it dropped. So that created a lot of opportunities. And even after the rally in April, even after that, we see now Morningstar's assessment for long-term returns for stocks and for high yield bonds in particular are higher than they had been for a long time at the end of the year. So U.S. stocks, they're only forecasting in aggregate for U.S. stocks to make 3% per year, but they believe international developed and emerging markets, based on current valuations, are going to make 8.5% or 9%. U.S. aggregate bonds offer very little. That's mainly the treasuries. They're not offering much of a return. But high yield bonds offer a 5.7% return, and cash is going to yield 1.1. So that's their forecast. Another way of looking at this, and these are numbers from March, but you could even put it up a little, it's still substantially the same, that if you look at the valuation of all of the companies around the world, of all weights, so all cap world index, the MSCI world all cap index, we're the long-term trend line, and this is for a very long period here, June 1994 to now, is 8.35%. So it's not the 12% that a lot of people talk about, but it's still a high return, 8.4%. And we're currently, our price trend's way below it. So there's a lot of catching up to do. So, for the next 10 years, the outlook looks pretty good. I mean, I'd say definitely 10% plus per year. And that's not bad news. So that's pretty good news. if you this chart just basically to show that when the government intervened, it intervened in the more liquid credit markets. So syndicated loans and high yield bonds moved differently. The things which weren't supported by the government didn't come up nearly like those which were. And the programs, for example, could buy high yield bonds. So where are we now on the offense defense measure in the bond universe? Well, we're in the offensive stage. We're buying, if you talk to Scion Ares, if you talk to PIMCO Flexible Credit, if you talk to even some of the more conservative liquid daily funds, they're looking further down to find more opportunities in places that we're avoiding. They've been buying investment grade corporate, looking very hard and buying selectively within the high yield universe, and especially looking at those residential mortgage-backed securities that are money good. If we're not in a Great Depression, and if we are, then it's so hard to guess what anything would be worth. So you see that this larger fixed income universe here, $43 trillion, $43 trillion, dwarfing U.S. equity market, dwarfing global equity markets, is mainly treasuries, agency mortgage-backed securities. So those are the insured mortgage-backed securities, investment-grade corporates, high yield, and some money market, municipal bonds, and agency bonds. But structured credit, those are the residential mortgage-backed securities that aren't owned by Fannie Mae and Freddie Mac, where there's some credit risk. And these are the commercial mortgage-backed securities, and these are the collateralized loan obligations, and these are the consumer asset-backed securities. This is where there's been very little support by the Federal Reserve targeted asset lending facility. So we see a lot of opportunities still there. And just looking at this, we have modeled various different scenarios of how this could play out. Based on those downsides, and have passed those numbers back and forth with other mortgage bond portfolio management teams to discuss what they see and don't see. And the bottom line is that there is a lot of opportunity in selecting individual bonds, individual packets of bonds based on zip code, based on FICO score, based on loan to value, based on seasoning. How long are they out there? There are different vintages of these things, and it's as clear as mud how to value them. But I have some understanding of it, and I've put together some spreadsheets, and I've been really spend days looking at this stuff. So again, also with the direct lending, the lifeblood of the U.S. economy, direct lending, there's been hardly any defaults within even average loan losses in direct lending, European. So, this is since, I think, this is since, I believe, 2004, this data, through the great financial crisis. We see lots of opportunity with Ares Capital Scion, the fund that many people own. And then we see that people don't understand, but if people do, let's say that we have a pretty bad economy. It's a significant unemployment scenario where a lot of people are unable to make their mortgage payments. Well, the good news is that there's mortgage servicing support. So for about a year, those cash flows are going to be supported by the mortgage servicing companies. And 47% of those are non-bank servicers who are not FDA, they're not backed by the Fed, but those nonetheless are very strong and should be able to weather all but the most dire of scenarios. And remember, these mortgage bonds that clients own were in such excellent shape, with the borrowers being on average above 800 FICO score, in prime, in the near prime, still good numbers. I mean, this is, I'm sorry, the $1 billion. That's not an 800 FICO score. The FICOs are also very high there, and I think about 750 for these guys, and then the subprime can be lower down the stack. But the housing shortage is real. So we see there are a lot of states here that still have over 5% shortage in housing, and we have a lot of other ones that are the majority of the other ones are still there's a moderate shortage in houses. There's a lot of demand for homes. That's going to be maybe a little less over the next couple of years, but it's going to come back. And anyway, the fundamentals for all this stuff remain strong. The other thing is that we know what happened during a crisis recently because we know what happened in 2017 when we had Hurricane Harvey, and there were selected pockets of the country where people had no job, no home, or their home was impacted and had to be fixed, but they stayed current on their mortgages. And for those who didn't stay current on their mortgages, these mortgage servicing guarantees backed by the Fed kept them whole so that they could restructure their mortgage and everybody got paid, which is good for everyone. So again, our best opportunities, and I shared something similar in the last webcast, but I want to do it again, are for the lower risk, we still like residential mortgage back, and after extensive analysis, I like all of the funds, including Semper, which is still down and it's taken a lot of time to come back. They're actually experiencing positive flows. Long technical story, but they're about a little over 20% underwater. And I did a severe stress case on them. And if we go into a Great Depression and we stay with 25% unemployment for 18 months, I believe you'll be whole. And I cannot see that we have a scenario where we have a liquidity crisis again, given the deleveraging recently that happened with the mortgage REITs, the private equity, and the hedge funders. We also like PIMCO income. We're holding on to whatever Braddock we have, and we're watching that. So we have a very, very little bit of that in a few clients, but which was also just heavily impacted due to their ownership of some securities, which got technically savaged in March, but we've seen a strong comeback. Much more to go there. And closed-end funds are harder to play. So we think IVA, FPA, and Centerstone investors will be happy with those over the long run. And for higher risk investor pockets of our portfolios, we're still using many of the same funds that focus on the wide moat and stock portfolio, the global small caps again, because as we believe going forward at some point, the world will be open again, but it's going to be more wary of long extended value chains, and there's going to be a lot of more local production, more local consumption. So one thing to keep in mind, always remember, if the long-term return of stocks, or even the last 10 years, if the long-term of stocks is 8, 10%, whatever that number is, the average investor over the last 10 years before this crisis, and we saw a lot of people bail during the crisis, is 2.5% per year. So, when the market made 6% in the last 10 years, average investor made 2.5%. And they did worse in international and so on. But inflation was 2.2, so your average investor didn't even keep up. So I want to end this Memorial Day message to you with a hopeful one. Okay, because spring is here. It's looking more beautiful every day outside, today being accepted with the rain. And I was on this call yesterday with Michael Milk and Scott Minerd, who manage, and Scott Miner's the CIO of Guggenheim, which has a bond fund we use. They manage $260 billion. Mike said this: in the application of epidemiology, everything is influenced by different life experiences. Parents thought, you can't have a good life unless you have an opportunity. The other thing is 98% of people will tell you things, and when they tell them and you quiz them about them, you find out someone told them that. So when it's almost always someone repeating hearsay. No one does the research. When people think back to when a little kid loved to quiz other kids on things like speed of light and so on. So it's crushing to discover adults didn't know. So Michael Milken was 7 years old. He talked about Sputnik, DARPA, NASA. Now it's similar to that. He wanted to run a space program in 1957. They wouldn't let him. So this organization announced a $1.2 billion investment in the AstraZeneca vaccine at Harvard. $482 million in the Moderna vaccine. The cost of human pandemic in lives, the pandemic in lives, is incalculable. But we know it's costing the economy about $1 trillion a month. So, and this was a revelation to me, he believes we'll have a working vaccine in September or October. But I think more importantly than that, he said this: my life focus, he has advanced prostate cancer in remission. My life focus is now on medical. We sometimes forget that on economic terms, 50% of all economic growth in the world can be attributed to public health and medical research. The greatest achievement of mankind is extension of life. By 1900, since the Stone Age, we extended life by 11 years. The last 20 years, we've extended life worldwide by 42 to 44 years. This has been brought forward by the pandemic again. The fastest vaccine in humans in history happened in 60 days at every level. Quality of life, safety, access to food, and shelter. This pandemic brings us back together. It brings us back to creating incentives to solve problems. We saw the cloud in the past, innovation group, all these people, the Nobel passed in 2014. We created markets and securities for index markets. People forget this, but Michael Milken, many people consider to be some kind of a criminal who was indicted for fraud, and he may have done some wrong things. He also created the way to finance the lifeblood of America and of the rest of the world, which is small business. And without that, without these structured credits and mortgages, without them, so many people wouldn't own homes. So many small companies wouldn't exist. So anyway, they took that energy and they applied it towards solving the acid rain problem. 10 to 15 years later, there's no more acid rain. So creating proper incentives solved this environmental concern. The last thing I want to say is all these people are important: grocery baggers, delivery men, and first responders. And we have to look past political bickering and ask who should have, would have, could have. And he said this, when someone asked me who should have done what, he says, well, what I'm going to do is say what I'm going to do today. So that's the question you should ask yourself: what are you going to do today? Thank you very much, and happy Memorial Day.